Hey everybody, it's Brian Shannon from AlphaTrends.net. Today's Friday, the 29th of April, and it's kind of a bloodbath here. Month to date, we lost 8% for the SPY, 13% for NASDAQ, 15% for the semiconductors. Only oil was up, and they were up, for the week as well, and positive year to date, as is the energy stocks. But everything else is across the board selling. Bitcoin down 14, 11.5% year to date. Just an ugly, ugly market out there. So let's start with the monthly chart. Here's the semiconductors. Here's the SPY. Just looking terrible. The volume weighted average price off of the COVID low obviously hasn't been hit yet in the SPY. Seems inevitable. In the NASDAQ, we're right on it. The Russell 2000, we're below it. Semiconductors, we're right on it. Biotechs, it's been below for quite a while. So we'll go back to our regular timeframes that we typically look at. I just wanted to point that out. Let's look at Bitcoin too, because it continues to be a disaster. I mean, it's just holding on the edge of this cliff here. And it seems to me as though it's likely to head down to the volume weighted average price from July of 2020. That had been where we found buyers in July of last year, and then again in later that year, and a little bit in January of this year. So Bitcoin is in a downtrend. No reason to be a buyer of that. This monthly chart just keeps it, or weekly rather, just keeps it a little bit more simple than looking at what we see here on the daily time frame. But we're below every key volume weighted average price. That's the year to date, etc. I don't want to spend too much time on Bitcoin because I'm more of an equities guy. And S&P 500. Again, we're at this volume weighted average price we've been talking about for a while, and cut through it today. That is the volume weighted average price off of the September 2020 peak. And next up looks like the volume weighted average price from this low, which is will bring us down towards about 406. That seems inevitable. It's very close. It's only at this point 1.5% away, and eventually I think we do get to the 38.2% retracement and test of the COVID low. As always, it doesn't mean it's going to go straight lower, but this is the fourth straight week down. And on the daily time frame, as we know, we've had some big rallies this year. I had pointed out that on a chart on Twitter earlier this week, outlining some of those moves. But again, we're just we're below a declining 20 and 50-day moving average. We're now below a declining 200-day moving average. All these stocks are getting annihilated. Even Apple, who last night was gapping up and had reported earnings, it came right up to the declining 50-day moving average. It's not supposed to move higher when it has a declining 50-day moving average. It's below the year-to-date VWAP. And then, of course, we have Amazon, which is a disaster also, just another disaster, doing what it's supposed to do in a downtrend. Some people think I'm picking on them and saying mean things about the market, but the fact is I've been talking about this downtrend for quite a while in these markets, and it's simply because I've been listening to the message of the market. Google isn't a downtrend. It's a clear stage 4 decline. If you buy stocks in stage 4 declines, expect to lose money. That's what's supposed to happen. Facebook, it rallied up to this, to the 20-day moving average, the 50-day moving average. It's at the 61.8% retracement of this high to that low. It's supposed to continue lower. That's what stocks and downtrends do. You don't buy them on a dip. This isn't a dip. This is a crash, just like last quarter, prior in Netflix. They're just, they're stocks in downtrends. They're guilty to proven innocent. Elon sold $4 billion worth of Tesla this week, and that brought it right down to the volume weighted average price we've been looking at from January of 2021. That's been an important level. So, let's take a look back at the indexes and not get off track there. We're still, again, we're below, we got above the 5-day moving average, but as I always say, we don't trust the rallies with a declining 5-day moving average. It's guilty until proven innocent. There's good trades on the long side if you're quick. And as I pointed out in Thursday night's video, I had participated Thursday, but I said there's no way on earth I was going to hold overnight because there might be an earnings disaster. And I didn't expect there to be one, but that's what the market gave us, was more earnings disasters. And the path of least resistance is lower. Call it a bear market, call it whatever you want. We're in a bearish trend, and we've had some bullish events this year. We've had some very good rallies, but the sum of those rallies is less than the sum of the declines, and that's the way it goes in downtrends. A downtrend once established is more likely to continue than reverse. That's just technical analysis 101. We've been talking about the downtrend in the NASDAQ. It came down to the volume weighted average price from the COVID low and the 38.2% retracement of the COVID low to the all-time high. That was undercut, and now we're closing below it for the first time. We for the first close below it, and it's funny to see all these people now tweeting about this. It's cool to see actually, because I've been talking about these anchored VWAPs forever, and it's great to see them catching on with the mainstream now, because this is the truth of price. We're below a declining 5-day moving average. You simply do not trust rallies when the 5-day moving average is declining. Doesn't mean it might not turn around, but what are the odds? The odds favor trend continuation on the bigger time frame with a declining 20, 50, 200-day, 100-day, etc. It just is a seller's market. That's all there is to it. Last night I spoke about the possibility of a continued rally up to Russell in the Russell 2000. If it was going to rally, it would come up towards this level. But instead, what happened? We got stuck right at that volume weighted average price from the high that we saw only last week, and that's this volume weighted average price here. We opened up at that level today, and then what? We just caved in from there, and a new closing low. We're in a stage 4 decline. This anchored volume weighted average price is a level of interest. The more times anything that has been support in the past is tested, the more likely it is to fail to hold. Now in this IWM, it seems most likely to me that we'll come down to a 50% retracement and this prior band of resistance down, another 10% lower. That is very realistic. Now, it doesn't mean it's going to happen next week or even next month. As we know, the way that stocks move lower, the way the markets move lower, is we have these fake out moves on the way up. So, we have to say, do we buy these or do we buy them for the short term? Because when they still have a declining 50-day moving average, they're guilty until proven innocent. Semiconductors, right on that volume weighted average price from the COVID low. If we put Fibonacci on here as well, you can see that we are, right below that 38.2% retracement. What's the next volume weighted average price level of interest? Well, we could put one off of this peak, and maybe that's, who knows, maybe that's going to be the all-time low. I doubt it. Maybe it's more likely that it tests a volume weighted average price from this low down near the round number of 200. That's only, that's still what is that, 10% lower. It's not a big move, 15% lower actually, but still, it's not a big move. It's not unrealistic to think that this market that had a rally of this magnitude in the course of 2 years could give back, more than even half of it. If it came back and gave half of it, it would be down to 210. Not unrealistic. We've been talking about biotechs, and this has been the example I've been talking about for the last month, that we got this rally right up to the declining trend line. Oop, that's not what I meant to draw. Let me just erase that. We got up to this trend line that we've been talking about, and that's where it happened to fail. Now, what we had happen was a good rally, but then when we look at that rally in the shorter term time frame, we had this pattern of higher highs and higher lows replaced with a pattern here where the low was broken and then we had a lower high. And then from there, it's been very clear, lower highs and lower lows all the way down here. So, this is the market, as I was saying, that up in here, I said, if they don't scare you out on the way down, they will wear you out during the accumulation phase. And it's highly likely that it would come down and test this low. Well, now we've undercut that low, and there is no level of interest that I can see, from a volume weighted average price that really looks relevant. Maybe, from the low of 2016, is that going to be important? The high of 2015 kind of comes into that area. Now, if that is the ultimate low in the biotechs, it doesn't mean they're just going to bounce higher from there. Instead, it's more likely that they're going to take some time to accumulate before they head higher again. So there's no hurry to get involved in a bearish environment. And the biotechs are clearly a very bearish environment. The energy, financial names, again, they're guilty until proven innocent. I've been pointing out that these look a lot like the Russell 2000 did in early January, and they're following the script. Why are they following that script? Are they similar? No, they're not similar in terms of what stocks are in it, but they're similar in the way that human psychology gets represented through the cyclical analysis and the flow of money across different asset classes. This market is likely headed to the 50% retracement here. That's the Russell 2000. Sorry, I meant to go back to the financials. The financials are likely to head back to the COVID volume weighted average price. And let's draw Fibonacci off of that. A 38.2% retracement, if I drew it correctly, is right around in this area as well. I don't see any reason why we're not going to see this at some time this year. I think it's a lot more likely that we see 32 than it is to see 39 this year, because up at 39, we have a declining 20, 30, 40-week moving average. We have a year-to-date volume weighted average that's declining. The question is, do you sell short after a decline of this magnitude? Maybe we fall apart next week. Maybe we're down hard on Monday. Tuesday, we see a turnaround and then a bounce, and then what? Then maybe it fakes some people out. People think it's all better again, and then it does something like this. This is the way markets in downtrends trade. Again, I've been talking about this all year. It shouldn't really be a surprise to people who understand the cyclical flow of money through different asset classes. It's been around forever. The energy names, came down to the year-to-date volume weighted average price. It seems as though they're just kind of running out of gas up in here. We saw a pretty sharp price correction. Now, I think the most likely is that we'll see a time correction, and if it can heal and move higher, that's great for the bulls, but there's no reason to be involved during this indecision. In fact, it might end up becoming distribution, break below the year-to-date VWAP, and head down for the year. Hope you had a good week. It's tough to see that a lot of people probably did have a good week in this market. It's treacherous. Believe me, it's not easy on the short side. I was long intraday on Thursday. I was short intraday today. I'm not holding anything. I'm 100% cash, and I have no certainty about this market. I expect it will continue lower over the coming months, but the path of least resistance is not without speed bumps.